What's up, guys? JC with Big Game Real Estate, and today we're going to talk about how to evaluate properties, how to determine if they're priced fairly, and if you're selling, obviously, how to price them as well. Change of scenery today. I'm actually visiting mom, so excuse the couch. Okay, so on a commercial property, how do we go about coming up with a sale price, or how do we, more importantly, as you guys are going out there pursuing investors, how do we figure out if it's a good deal? Let's take a look. So number one, if the property is vacant, okay, so the property has no tenant or no tenants in it, how do we evaluate that property? Well, how we're going to do that is by what we call the price per square foot method. So that means we're going to take what the person or group is asking for the property, okay? Let's say that's $2 million. I'm going to do this with you guys so we make sure we have the same math together, all right? So you guys know if you're right. So let's say the price of the property is $2 million. And the property is 15,000 square feet. So we're going to go ahead and we're going to divide 2 million by 15,000 square feet, and you should come up with a number of 133.33333. That means that this property is priced at $133 a square foot. If we reverse engineer that, okay, and we just click clear, and we do 133 times 15,000, you get a number. Again, it was a decimal point, so we're going to be a little off. You get a number roughly 2 million. So you can check and confirm your numbers. Again, now, is that price of 133 a fair price? That we don't know. That you're going to have to look at other market factors. You're going to have to look at the building. You know, might be priced lower. Could be because it's a potential value add opportunity. Okay, but what if it's priced higher? Well, now we have to find out, why is it priced higher, okay? And what that could be is there could be an additional use or expanded use, potential reposition for the property, okay? Like we spoke about in some of our other videos with adding value or adding a tenant. Someone may say, look, I'm pricing it at 133 and market is showing it's worth 90 because I know that you can do this with the property. There's a benefit here. And then we just negotiate from there as to, what number we come up on. So again, you need to know the baseline of what the market is, condition of building, and what is fair in the market. Okay, GRM. GRM stands for gross rent multiplier. This is not a method that I like to use, especially if you're getting in the business. This basically is dividing the purchase price by the gross rent. It is a line item. If you're, doing some kind of portfolio purchase or you're a larger group, you'd want to know it. Generally, guys like to see minimum 10 to 12% or 10 to 12 multiple rather. The issue I have with this, especially getting involved, is it doesn't take into consideration anything, taxes, mortgage, expenses. It's just a broad number. So for me, I choose to avoid this method because it doesn't tell us a whole lot. It's an important spreadsheet item when we consider other factors, but as a standalone, I would not use it as a standalone evaluation method. Price per door. Now, this is regarding multifamily, okay? You're not going to see this on an industrial park. You're not going to see this on a multi-tenant shopping center. This is specifically for multifamily buildings or multifamily developments. And what you'll hear is I'm priced at $50,000 per door, okay? What does that mean? Well, if the building has 10 units and he's saying, or she, or the group is saying, I'm priced at $50,000 per door, that means it's priced at $500,000. Generally, you would see that wording on a development deal. How would you reverse that? Well, if the building is constructed and again, it has 10 units and the guy's priced at 500,000, you can do the math. Okay, well, he's priced at 50,000 per door. Is that in alignment with what other market factors show us? Do we have comps that show that that is fair? If the building is tenanted, you're going to use what we're going to talk about next, the cap rate. But again, knowing the price per door on multifamily is also important in addition to the cap rate, because you may have a good cap rate, but if the price per door exceeds what is quote unquote market, we have to do some more digging to find out why that is. Sometimes it could be as simple as this particular building is a luxury building. It offers a lot more amenities, and there's really nothing else of it nothing else like it in the area, etc. So, and that's okay, but we need to know the answer to that. Okay, so let's talk about the most commonly and widely used, which is the cap rate evaluation method. Again, if you're looking on LoopNet or CoStar or Craigslist or anywhere, you're going to see 5.6% cap, capital CAP. That stands for cap rate. And what is that telling us? Well, what that is telling us is that is the rate of return, essentially, you're going to get on your money. But how do they come up with that, right? It's not a bank rate of return. And the way you would come up with your cap rate is you would divide, well, first of all, what is the cap rate? Okay. The cap rate is based on the net operating income. All right. That means that's the income of the property minus taxes and expenses. It does not include the mortgage. Okay. And that's a very important factor, especially for new people, because think about it. If mortgage rates are at a 6% and the cap rate is 5%, you're losing money, right? Because you're borrowing money at a higher cost than the rate of return on the property. If you're buying it cash, you know how much money you're making. But let's do this, guys. So let's say there's a property and it's priced at $2 million. Okay. Bear with me one second. So let's say we have a property that's making $150,000 in net operating income. That's after taxes and expenses. Owner says it's making $150,000. Okay, at a 5% cap rate, so $150,000 divided by 0.05, that would give us a $3 million evaluation on that building. Now that's good if you're door knocking, someone says, "Hey, I don't know what the price of this building is." Okay, well, I'm going to take your net operating income after I receive those documents from you and confirm them, and I'm going to do an evaluation here based on what I think where this property falls in the market. This is a very, very useful tool and a need-to-know tool if you're making calls to your investors or trying to secure an investor. What rate of return do you look at? We look at 6 caps. Okay, so that means if you're out there looking for something, you got to find a 6% cap rate. Most of you guys are not going to be cap rate investors at this point. And be advised that a cap rate works inversely to the price, meaning a 5% cap rate has a much higher price than a 10% cap rate. A 5% cap rate is a much more stable asset than a 10%. The higher the cap rate, the lower the price, but generally, comparatively, the more money you're making, okay? So a cap rate investor is someone who's looking for a stable asset or stable assets with a stable tenant or tenants, generally larger tenants, okay? It's a safer investment than something like a 10% cap rate. And if you were coming up with the price of a property and you were selling, you would simply reverse engineer that. Now, again, is that cap rate acceptable? We have to look at, well, what is this type of property selling for in our market? What type of tenants? There are other market factors. This is really just a back of the napkin way of determining an evaluation of your property and does it fit. Again, if you know you're looking for a 10% cap rate, someone gives you an NOI and it's at 7%, it's not going to work. Another way you can utilize this is if you're out there door knocking and you're trying to find some properties and you run across somebody and you say, "Look, I want to buy a property," and they may say they're interested. Okay, great. What's your property making? It's making $100,000. What are your taxes and expenses? I don't know. Okay. Did you have an idea of what you wanted for the property? X. Well, now if you run your cap rate evaluation method and X is a percentage that you're not comfortable with, once we start taking away expenses, more expenses and taxes, and even a mortgage, you're going to be nowhere near profitable. Okay, so again, cap rate evaluation method, this is good as you're looking for properties on LoopNet so you understand them. If you're out there in the field, you can get an idea of what a property is worth. If it meets the requirement or it's close, I would say that's a good indication that we should now continue the conversation and pursue to other factors such as what go into the expenses, tenant lease terms, etc., etc. By the way, a cap rate can very much be affected by the amount of lease term that is left on the leases from the tenants. And we'll talk about that in future videos. Guys, JC, Big Game Real Estate. Have a good one. We'll see you next time.